All right, hi everyone, and thanks so much for joining the Life Design Analysis October webinar. As usual, I'm your host, Charlie Conron, founder and Chief Technology Officer of Life Design Analysis. Now this month, as like every month, I think we have a really great webinar for you. We're focusing on life insurance product hacks, and if you're hearing that and thinking hack, I always think of that as a bad thing, as in breaking into someone's computer. We're thinking more in terms of a life hack. So a life hack is any trick or shortcut, skill or novelty method that increases your productivity, efficiency in all walks of life. So you might think about someone who's using chopsticks and wraps them with an elastic to make it easier to use. In some sense, even life design analysis is a little bit of a life hack in that it makes your insurance practice more efficient, more effective. It makes you look like you've actually done a lot of work to produce that presentation, where we're really trying to save you time. Now, what we wanted to focus on for life insurance life hacks or product hacks were ways that you could use sort of product design or loopholes that are built into provision. So, not anything that's outside of what's legal, but just really best practices and sort of, hidden tips and tricks in the insurance industry. So we've got some great life insurance life hacks. Our first one, we're going to show you, if you have a rated client, one way to enhance the return on investment for them. We're going to show you a UL product hack with kind of an ART rider that's going to maximize credit to the CDA. We're going to show you a Manulife term product hack for clients whose either their health rating has changed. And we're also going to have, as I mentioned, a very special gift, Ami Maishlis from LifeGuide, who's going to show you how to use an optimizer hack. And I think this one's a really great one. We also have a little bit of a sneak peek of LifeGuide Web coming for you. So again, look forward to showing you that. And one other life hack, of course, is the exclusive discount Life Design Analysis gives for LifeGuide subscribers. So can't wait to show you all of that. So without further ado, I'm going to jump into my first life hack. Again, if you're watching this for the first time and you want to perform any of these concepts after the webinar, don't hesitate to sign up free and start your 30-day trial. If you're an existing subscriber, of course, you can log in from any different device or platform. So I'm going to start off here and jump into my account. All right, so my first product hack, I'm going to be working on a Forrester's example. Client Phil Mickelson here. This is sort of my standard 40-year-old male sample case. Now, this really works on any sort of client that you're working with that has a rated case. And essentially what I'm going to be working with, and I'm going to flip over here to my illustration platform, is, again, essentially a 40-year-old male who has a rating. Now, one of the neat things about the Forrester's plan is that when you do a rated amount, and you can just see, I'll just show you how I've set this up. So again, you can see that on all of them, I've done a 200% rating. Essentially, I'm using the enhanced coverage option, which splits, sort of my total $1 million into a basic amount, 458, and an enhanced amount, which is a YRT rider essentially built into the whole life. Now, again, contact your wholesaler if you want details on these plans, but generally the way an enhancement option works is that there's a base, which is sort of the PUAs, paid up additions. They buy out the YRT. So as this base sort of has paid up additions, instead of adding to the total death benefit, it's actually trying to reduce and replace this number, the enhancement, which is a 1-year term. And ideally, that whole YRT part of it is replaced completely so that it doesn't increase in cost, and then you're left with full, sort of paid up addition base as that thing is removed. But the neat part, as I say, about this concept is that the rating does not apply to the enhanced amount, and that's the kind of the lion's share of this. Now, that's not necessarily true with all other plans. So you can see, where I've drawn up this plan as a 20-pay $1 million with sort of my enhancement here. The premium is $14,000. If I do the same sort of thing, so 40-year-old male, you can see I've got a 200% rating. My coverage, again, is set at $1 million. This case, again, I just sort of let it do its thing for a lifetime guarantee on the enhanced option, and it sort of splits out for me what the ECO amount is versus the base amount. And again, you'll see we've got a slightly different price here, for the overall cost. And if I just view this quickly, you can see it's $20,000. So quite a big price jump from the Forresters. And again, I've designed this as well in a Manulife. They call theirs a term dividend option. Again, you can do a lifetime guarantee, and you can play with that enhancement a little bit. But again, I put $1 million, and you can see we've sort of got our enhancement there. Now, I have set this up as a payment for 20 years, but again, you're going to see a much higher premium, and when we import these into our system, what we're going to be trying to do is basically focus on IRR to maximize it. Now, to do any of these sort of product comparisons, and these are kind of how you find these product hacks, again, you want to do your due diligence. So again, I'm going to add the 3 different whole life plans here. One's going to be a Canada Life, one's going to be Manulife, and the third one is going to be Foresters. Okay, so I've gone ahead and added those. Now I'm going to bring in the whole life spreadsheet. So I'll start here with Canada Life. I've got my plan. Again, I'm going to go view data, and then I've got to go export to Excel. It's going to send me all of the information about the quote exactly as I've designed it. Again, Foresters, same sort of thing. It's right at the top, export to Excel. And Manulife, same sort of thing, view data, export to Excel. Now, this is going to open me up 3 different Excel sheets with the respective products. You can see I've got my Manulife one here. I'm going to grab the information and copy it, come back over to LDA, and paste it in there. So grab my Foresters, copy it, come back over to Foresters, paste the information in there, and I'll hit upload. I don't think my first one grabbed that menu. Let me come back over here to Excel. This is the Canada Life one, GWPR, Great West. Copy, come back, paste that in there, upload, come back to Excel here, and that was our Foresters, and here's our Manulife again. So let's copy this, and we'll paste that right in there. Okay, so I've got all 3 of my plans designed and imported in there, trying to keep them as close as possible. I'm just going to go down to the report components. I'm going to take away sort of my regular cash value insurance benefit. Instead, I'm going to elect for the overlays. I'll leave my presentation summary. I'm just going to get rid of some of these charts here. I do want to include tables of the IRR and charts, but we can get rid of the equivalent ones. We're going to go ahead and generate these. Again, for those of you watching for the first time, this is Life Design Analysis, a system designed to make that case research and presentation that much easier. Let's dig into the report and see sort of the product design features. So remembering we designed $1 million for all 3. $20,000, $17,000, and $14,000. So as you'd expect, lowest cost on the Foresters there, and I think that's partly in part because that ECO amount is not being rated. As you'd expect, lower total amount. Now, generally, though, the other thing that comes with that lower total is a lower cash value. But you can see, in this one, we've got the Manulife here, and you can see it's actually lapsing here at year 31. So, again, it didn't survive the 20 pay, so it's out of there. The other 2, though, again, fairly competitive. You can see the Canada Life plan has a lot more cash value. But, on the other hand, you would sort of expect that given that the premium deposit was $6,000 plus more per year for 20 years. So this is where we really want to look at an IRR and see some of that product efficiency. Again, I'm going to go to the overlays where you can see sort of a similar pattern there. But when we get down here into an IRR sort of conversation, again, the Manulife one goes to 0 because the product lapses there, so we can get rid of that. What you can see here is that the Foresters actually has a higher internal rate of return. Again, you're not paying as much premium, so when we adjust things, it's sort of like a dollar for dollar comparison. You can see it actually has a greater efficiency. And on the insurance benefit, again, I'll just get rid of the menu because it lapses out of there, you can see that's even greater. And part of that has to do with product design. Again, a lot of it, especially in a rated case where that enhanced amount on the Foresters is not being rated. So that's my Foresters insurance product hack. But remember, you'll find these sort of product sweet spots by doing some of this comparison. So when you are in a competitive situation with a rated client, remember, think about that sort of product hack. All right, for my next product hack, I'm focusing on a little bit of an older client. This is more of a corporate estate sort of transfer scenario, and I find this is a really neat one here when working with a client who has, maybe a large sum of money they want to move off the balance sheet and into a more efficient asset. So I'm going to focus on a 60-year-old client here, and I just have a Mr. 60 client created in the system. So I'll pull them up. As you can see, 60-year-old male here. Now, I'm going to be focusing on universal life in this, and again, this is a BMO hack that I found with just sort of playing with different products and riders and sort of playing with that MTAR line. I'm going to compare it with just sort of another very popular U out there and try and match it with Manulife. But again, do some research. I mean, if you have another carrier that you think this might work for and they have the similar rider, again, play with this and do some comparison to see what you can work with. But really our goal in this sort of concept is going to be trying to be maximizing the CDA value for a corporate client. And a lot of that has to do with product design and how that ACB grind down happens. So even though plans may have a similar IRR or similar cash performance, there may be a very drastically different ACB for the plan, and that's going to impact the CDA credit that will ultimately influence the estate. So in my first one, I'm going to bring in my baseline example here, my BMO, and I'll just flip over here to show everyone what I created here. So you can see, again, I've set it up as a universal life. I'm no expert in this, so do contact your wholesaler to, again, even further maximize how you can design these plans. But you can see I've got $1 million here. I've set up the cost of insurance as the YRT 8520, my client 60, and I'm going to illustrate all of these at 5% in both softwares to keep it fairly generic. Now, again, I've put $100,000 over 20 years, but customize these for your particular client or the depositor that they're trying to move from sort of column A to column B. Now, the interesting thing that I'm using here is the ART term rider, and I'm using $1 million, and I'm going to say for 40 years here to bring it all the way sort of to age 100. And again, same sort of process to get this in Life Design Analysis, same steps that we always do. We view the data. We send this spreadsheet, or like I like to think about it as the digital fingerprint, to Excel. So we hit those, the export to Excel button. And from Excel, again, we can highlight everything. I'm just using Control-C, but if you want to take a look, we're just basically copy the information. And I'm going to come back to Life Design Analysis, where I'm just going to paste all of that information in. And again, looks jumbled, don't worry. We sort all of that out on our end. While that's uploading, so it's already in there, I'm going to go and design my Manulife product. So I'm going to flip over to Manulife's software here. I can get rid of my old BMO spreadsheet. I don't need this anymore. And I'm going to try and design a very similar, if not the exact same sort of plan. So you can see I'm using Innovision here with valued client. Bonus, I believe. Again, talk to your wholesaler to maximize this area. You can see same sort of costing of insurance, a little different, 8515. And I've got the 20-year rider here. Now, they don't have an ART rider, so I'm trying to use this, again, to maximize that term rider. But I'm just going to have it go 20 years because, as we know, this client's 60, and that's going to expire at 80. You can see annually $100,000 for 20 years and the same 5% rate of return. So I tried to match it as close as possible. And I did check around to see if there's any other ART. That might be something that is unique to BMO. I don't necessarily know, but if you do have another one, make sure you leave me a comment. I'd be happy to update it, and make sure to run your own examples to vet this sort of scenario. Same process, a little different looking spreadsheet, but all we have to do is grab everything. I just clicked the copy there, but again, you could copy it like that, and just come back to Life Design Analysis, paste that data in there, and upload it. And it'll upload. If for some reason you can't really go wrong there, it'll give you the success message either way. I'm just going to pop down to the controls as well. I want to get rid of some of these. Whenever I'm doing two whole life plans, again, they have the exact same annual premium, so they're going to have the same sum of premiums. Sometimes I just like to show the total, so I keep it there. I get rid of individual cash and insurance charts just by clicking them off there. Whenever I have multiple cash value products, I elect for the cash overlay and insurance overlay. As I talked about, we're going to be focusing on credit to the CDA, so you can have the chart, or if you want a table. I'll leave the presentation summary. I like that, but I'll get rid of some of these other ones. They're not as relevant in the case because, again, we have a sole focus of maximizing that credit to the CDA. So I've got my kind of report component set with the way that I want my report to look. All that's left to do is click one button to generate the report, and I'll show you this sort of product hack that I think is all due to that ART rider, and I think it's maximizing sort of that MTAR room and again, really does a lot $100,000 deposit, given the same sort of thing. So you can see here, again, same premium, so we'll get the same sum of premium. Looks like it's just the Manulife BMO is just tucked directly underneath, and the reason these lines are the same is, of course, because the deposits were the exact same, $100,000 for 20 years. In the cash overlay, you can see this is where it's fairly dramatic here. So for the first 20 years, again, very competitive performance. You can see even at the 20th year, Manulife has a slight edge, but that term 20 drops off, and we can see again, the policy performance dip and that cash value dip out of that policy. Now, same sort of thing with the insurance benefit. We can see the insurance benefit slightly edges in favor of BMO, but then this is where the real big dip is in these years 80 to sort of life expectancy and out. And again, you can look at the pretty significant difference there when that term rider drops off and we've maximized that credit to the CDA. So this is a great way to sort of compare the two different for a corporate client. But again, maximizing sort of the deposit room with one of those ART riders can have a really big impact when you come across a corporate client like that. So again, really interesting chart there. And again, if you wanted to compare that in the table as well, you'd see quite a big difference as we get to the sort of life expectancy and beyond. So that's my BMO life insurance hack. All right, so for my next life insurance product hack, I'm going to focus on a Manulife concept. And this is really one for clients who are rated or possibly clients who have a term policy and were standard but are now rated. You may want to look inside your in-force block of business for people, around 60 or something like that. So anyone really who bought a term 20 policy, likely by the time, when they bought it 20 years ago and by the time it comes up for renewal, their health may have drastically changed and they may be rated on any new offer now. Great concept, again, presumes a client has an existing term policy. Now, one of the neat provisions within an existing conversion or a partial conversion with Manulife is that if you do convert a part of your term policy, the rest of it can be reissued as a term rider. So, for instance, in our example, we're going to be focusing on doing kind of a partial conversion on a term 20 and reissuing the rest of the term rider. So let's just say, for instance, Mr. 60 has a term 20 policy that's we think they're going to be rated and they're not going to be able to get any more insurance. They bought this policy, let's say, when they were 40. A lot has changed, and they're coming up to that renewal period. Now, of course, they do have the option to convert, but perhaps a full conversion is out of the question. Well, one of the neat things that you could illustrate for them would be this sort of product hack with Manulife, where you could convert a part of that existing term policy and have the rest as a term rider. So let's just say, for instance, we want to illustrate this and show how affordable we could make a partial conversion for them. We're going to be using, again, a Manulife Whole Life. Now, of course, I would recommend illustrating their existing term 20 in this report as well. So again, if they bought it when they were 40, a term 20 when you're 40, well, we'll add one in there. We'll just kind of give an idea of what that would look like. So if you ever want to simulate a rate, you can say 40. I'm just using our LifeGuide integration. Make sure you ask us about LifeGuide discount exclusive to LifeGuide subscribers, and I'll work with, let's say, $1 million. So I just want to check on and see what a viable price would be for this particular product. We're going to pretend they're 40 here, and again, we can see $974 annually. So they've been enjoying, a relatively low rate, under $1,000 a year, maybe just over. Term pricing has come down a little bit, but that's sort of what they'd be expecting to pay. So again, we don't want to jump up too much. A full conversion to the par would be really, really expensive for $1 million, and we're going to pretend that we want to keep, most of that insurance intact. So what I'm going to do is actually go back to my case here, and you can see I've got a Manulife Whole Life set up here. Now, to keep this premium palatable and to keep this sort of my life insurance hack, what I'm going to do is open up sort of a new PMAX Gold one. And the reason I'm doing this is because the premium is a lot more palatable. So remember, we can do a partial conversion. So again, I'm going to update my client here to be 60. We're going to pretend, though, that the health style stays the same. So again, they're doing a conversion at their original health style. So I'm going to keep that at 3, whereas now our client would likely get a rated policy, and we'd have to add a rating into there or change things around. Now, what I'm going to do here is I'm going to say $25,000 is the conversion for the PMAX here. And you can see that's going to drop my price to a fairly low number. I don't think you can do any lower than that, but again, this sort of concept, let me just see what the minimum is here. So yeah, minimum allowed is $25,000. I just wanted to double check. And then the other thing I'm going to do to even drop this premium even further is instead of doing paid up insurance, I'm going to do the term option. So this is sort of like that enhanced option. You've heard it called from other plans. Reach out to your wholesaler for details, but essentially it's an ART policy mixed with the term option. The whole idea is that the term replaces the paid up addition or the performance credit pays out that term option, and eventually you're left with all that base. We're doing it mostly for price, and again, a lot of people sort of work with the minimum or the maximum lifetime guarantee just to be on the safe side here. But you can see, again, I've got my minimum amount of insurance. When I added the term rider, it actually bumped it up to 26. But now what I want to do is I want to go into my term riders. I'm going to add one. And again, instead of doing the full million, I'll have access to $974,000 of additional that I'm not converting that I could add as a brand new 20-year renewable policy. Now, again, given that this client is 60, that's going to take them all the way to age 80. And again, we're still going to keep that premium somewhat affordable here. So again, coverage back here, 60. We've got our base. We've got our riders. And again, you may decide to reduce that. When we update our summary, you can see we've got, a decent number. But again, when we look at this in comparison to what the client would currently be paying, it's going to make a very compelling presentation. So what I'm going to do is I'm going to export that. Again, feel free, if you wanted to, reduce that amount, you could always play with that. You don't have to keep the full million in force there. I'm going to come in just like we did, whenever we bring in a spreadsheet, we can either copy and paste or save the data. I'm just going to paste it in there. And again, we've got, sort of our existing plan versus the new plan. Now, again, remember, I went back and backdated to 40 just to kind of simulate the existing plan. What I'm going to do here is I'm going to say that this was issued. I'm going to give it an issue date. And I'm going to say this was issued in 2000 and make it kind of like 19 years old and just show, sort of what would be possible or what, sort of trajectory the client would be currently on versus, what we could create as a conversion. Now, just before I hit generate report, one other thing that would be really neat to show in this sort of report would be what a new term 20 would cost for a rated client. When we do our search, unfortunately, we don't get rated values in there. Really easy to pop in a rated T20 though. All I'm going to do is go into the manual, say term 20, and I'm going to say potential new cost. And I want to illustrate, what we think a new policy would cost for this client, because again, we know that they're going to be up against a rating, not necessarily being able to buy just a standard issued policy. So I just want to take a look at what the cost would be. And again, I'll just kind of close this out here and just take a look at some family terms. So I just got a 60-year-old. Again, but I just put a insurance rating of 200% on there. So again, this would be like a rated client, adjust accordingly. But just to get kind of an idea, it's about $19,000 a year. So all I'm going to do is just say this is $19,000. And again, I know it's renewable till age 80 and convertible till 65, so I'm going to throw that in there as well. But I'll just save that as a policy just to show, here's your existing plan and the trajectory. Here's our partial conversion or our insurance hack where, again, we convert the bare minimum and issue the new part as a new term rider. And, just showing what a rated policy would cost in there as well. I'm going to go ahead and generate that, and we can take a look at this sort of insurance loophole or insurance life hack. Okay, so we've got our report. We're going to jump down into it so you can see the existing policy. Again, remember we kind of backdated and just kind of got a conceptual idea of what that would cost. And you can see, they're going to have that remaining year until that renewal point. This may vary depending on the issue of your policy. But again, think of this concept for anyone who has health change, maybe can't afford a full conversion, and has a Manulife policy of a term policy. Again, you can see the renewal is going to be, $9,000 to $15,000 is going to be pretty drastic. A new rated policy at $200 is even $19,000. So this is where, they'd be better off taking that renewal even than applying for a new policy. And you can see our solution doing a partial conversion is going to cost $11,689. And that's because part of it is the standard new term, and the other part of it is that PMAX, but with term dividends. So we're able to kind of make a more palatable solution there. And again, not hard to see. Obviously the new policy is out there because our renewal is potentially even less than that. Renewal does expire, and again, it's still more expensive than the solution we're proposing. And our solution, again, is actually going to include some permanent in there, so you can see, after that 20 years and that term rider, sort of the reissued term rider that we got on top of the minimum conversion is gone, we're still left with some permanent insurance. So again, when we look at the cost, we're definitely cost effective. Our solution stays in force. We even build up a little bit of cash value in the policy if you don't want to show the costs there and just focus on the cash. Again, life expectancy, $33,000 of cash, not bad. Certainly some possibilities with that cash that you could use it. But what I really like here is, again, we maintain that $1 million insurance benefit all the way up until age 80. And then you can see we have some in force. Again, if you want to get rid of premiums, just click that legend item and you can see, final expense insurance left in place, $50,000. Not a bad solution for someone who's rated. So that's my Manulife life insurance hack, and I hope you can think of a few clients to use that on. All right, so my next product hack is going to be focused on UL, or more appropriately, a replacement for a UL. Again, I'm going to use Mr. 60 and just kind of keeping with the theme here. But I think this concept can be used almost across the board. And I'm going to focus again on $1 million of insurance, but adjust accordingly for your face value. I'm going to start off and I'm going to add a min-funded UL. And again, this is sort of, min-funded ULs, traditionally the price has been on the rise. I'm going to go ahead and search the market and just see what, sort of a baseline cost would be for a 60-year-old. Again, maybe slightly higher, but they're at about $23,000. So I'll just take the best result, $23,194 from Sun Life there, and add it to the case. Now, that's quite a lot of value, and we're not going to see much cash value or things accrue in there, but this is, again, someone who needs insurance for life, needs to do some estate planning, that sort of concept. Now, we don't want to build a lot of risk into this, but we do want to find something that we can compete with this $23,000 number that's going to offer a little bit more value. And in this concept, I'm going to use one of the plans with an enhanced option. In this case, I'm going to use Equitable Life. One, they have a very strong dividend rate, which I think is going to be favorable in this sort of scenario. And two, they offer the option of adding multiple riders. So I'm kind of combining what I used to call the trifactor, which sort of combines some term 10, some term 20, some whole life, but with the economy or the enhanced dividend option. And we're going to see if we can match this $1 million of insurance benefit for a lower price without taking that much risk. So we'll be looking at the, kind of the reduced examples and things like that as well. But let's go ahead and design our whole life example and see if we can do this here. So I'm going to go pop over to my Equitable illustration and just show you what I've set up here. So again, 60-year-old male. I'm using the life enhancement. You can see I've switched it to the dividend instead of paid up additions, which are probably the most popular, going enhanced, and that's to really work with that price. You can see I've put 500 for my base face value, and then what I'm doing is I'm adding 10 and 20-year riders, both in the amount of 250 to make up the 500 at age 70 and 80. My hope in this is that the base plan, the enhanced whole life, sort of can grow up, replace that rider, and by the time that T10 falls off and T20 falls off, we have enough insurance in place. So let's take a look at how that looks. Again, same sort of process, view spreadsheet, send that off to Excel. Gives me my nice warning message. Sends all the data to Excel. Again, all you have to do, click the corner, do a copy or simply copy, and come back to Life Design Analysis. Simply paste that all in there. And as usual, all jumbled, we sort that out on our end. We make it really, really easy for you. Now, once we upload this, what we're really going to be focused on is the insurance benefit and the cost. The one nice thing about this plan here, though, is that we are on a 20-year pay schedule. So I set those plans, just while that's loading in there, I'll just show that I set those plans to drop the term rider after in our illustration. So if we go back, I'll just show in my riders that I had them expire 70, again, this client 60, so to age 70 and 80 respectively with their term length. So we're not going to see some of those renewals in there. Go back to Life Design Analysis and let's generate the report and see if we can do sort of a universal life hack where we're matching the same premium but in a product with a little bit more value but still maintaining that $1 million benefit. So you can see we're slightly off here. Again, our cost is going to go down when that term 10 rider falls off. Again, it's going to go down when our term 20 rider goes off, but we're actually going to zero premium payment after that. Both have $1 million. And again, you can see we're fairly close in the cost, but where we're really going to win out is after age 80, because again, in the one plan, we're done paying after the 20 years. Again, we can see that that crossover doesn't take long. And I guess again, especially when we're talking about fixed income, a lot of times this is sort of our depletion years, and then we really want to minimize cost in our inactive years. We still want insurance in place. And again, let's look at the cash value. So great cash value in this. We've got some guaranteed cash value, so even if we want to focus on the guarantees and things like that at the break-even point, around age 83, we still have $360,000 of guaranteed cash value. Now, the insurance is interesting here, so you can see my layers didn't quite catch up. I mean, we ultimately come back to the $1 million at 20 years and dip down. So these little triangles would sort of represent little gaps where we may not have enough insurance, especially at age 71. We're down to 750. And we kind of come back to that, that level as we kind of drop those term riders. Eventually, though, we get back up to that $1 million. So, again, to solve that, you may add a little bit more base and keep the term riders the same to slightly overcome that. You may just leave the gaps and say, at sort of those, kind of life expectancy, we're roughly around that number. But again, when we look at it from like an IRR standpoint, we're certainly maximizing the IRR of the insurance benefit when we pick this sort of product. So again, much better going out to life expectancy. And we have some cash value that we could think about leveraging within that policy too. So that's kind of my universal life hack, using a sort of an enhanced dividend with two different term riders on it to sort of make up that time period where the paid up additions are still replacing that ART. So again, there's my universal life hack using Equitable Life as a UL alternative. All right, so for my next topic, I have a very special guest and someone I've been trying to get on a webinar for a very long time. So I'm really happy to introduce Ami Maishlis, who is the founder of CompuOffice Software, which everyone here probably knows much better as the designer of LifeGuide. So Ami, thank you so much for joining us. I'm really happy to have you on our webinar.
Thank you, Charlie, for inviting me, and thank you everyone for joining in.
So a couple of the things I wanted to talk about today, of course, our theme is really around life insurance, life hacks, or ways we can get the consumer sort of a better benefit. And really, when we were introduced on me, that was sort of the main thing that I think we connected on, is that both of our softwares are really designed to help the end consumer. We really want to enable advisors to give the consumer the best experience possible, and we really find that's the win-win. There are so many mutual benefits of this strategic alliance that we form with LifeGuide. LDA certainly would not be what it is today without you guys, so we're very appreciative over here. A couple things we wanted to do today. One, I want to show you a great mutual benefit that really benefits all LifeGuide subscribers as well as Life Design Analysis subscribers. And that's the mutual benefit of having both of our platforms. So the first, sort of topic I wanted to touch on was the discount that I'm always mentioning in all of our webinars. So I try and mention this everywhere. If you are a LifeGuide subscriber and a Life Design Analysis subscriber, you get a discount of 50% to Life Design Analysis. And I always mention you enter your serial number to receive that discount, but I'm really happy to show you how to do that today. So I'm going to go over to the Modify My Account, and I just really want to quickly show you how you can take advantage of this discount. So you can see on any of our subscription packages, and we do have a few to choose from, I've selected the Premier package billed annually, and that's our top level package. Now, generally, you can see today you'll be billed $1,188. So that's the full cost of our platform. But you can see that when you want to save time and money, you are eligible for a 50% discount by having LifeGuide. And I just want to show you how to apply that LifeGuide serial number to receive your discount. So essentially that serial number acts as your discount code. Now, what I'm going to do is I'm just going to navigate over here to kind of the LifeGuide application. So if you're not familiar, if you haven't seen this before, this is LifeGuide software here, and it's the premier multiple quotation platform out there. Really, the information that it has in it is extremely robust, and maybe Ami can speak to some of that a little bit later on. But what I wanted to draw your attention to, sort of top right corner here, is that LifeGuide serial number, and you'll see generally starts with LG and your province abbreviation. Now, all you need to do is grab that code and enter it in as your discount code. And I'll just go back here to the web just to show you again where you would enter that in and show you what happens. So actually I've got a version up here with a serial number that I can actually copy and paste. So I'm just going to grab my serial number here from LifeGuide, again, top right there. I'm going to come over to the modify account, and I'm just simply pasting that serial number in there. You can also type that in as well. And watch what happens. When I hit apply, it checks the serial number with LifeGuide and comes back, and it is a one discount per serial number, but you can see that price has been discounted by 50% down to $594. So a considerable savings for subscribers of both of our platforms. And again, that benefit was passed on from Ami himself. And Ami, maybe tell us a little bit about some of the other mutual benefits of being subscribers of both platforms.
Thank you, Charlie. And I will probably be asking you to bring up LifeGuide. Perhaps let's do that now. Bring up LifeGuide so we can actually demonstrate this. Okay, we've got interesting parameters here. So let's run this. And let's say that this individual here, Mr. Example, is shopping for insurance for his mortgage. He's got a 20-year mortgage. He'll probably move during that period and continue owing that kind of money in the form of a mortgage debt. And he's considering getting the mortgage insurance from the Royal Bank or getting it individually. So he's shopping for that $450,000 worth of 20-year term. So let's run this quote.
So I'm just going to quote single life, single insured here, and we're going to produce our results here.
Okay, so if we hit the letter R to jump down to RBC, we see that they charge $413.50 a year. The question is that what it will cost for $450, and is there an opportunity to get some additional coverage at no additional cost? So let's click on the icon up at the top that looks like a target, and that's the Opti value. Okay, go ahead, Charlie, click on it. It now optimized for the same $413.50 a year on the same Your Term 20 standard non-smoker, same person, same everything. We can get $551,706 worth of coverage. So it's $100,000, a little bit over $100,000 more coverage without a penny extra in premium. Obviously, that's in the better interest of the client than just getting $450 for that $413.50.
Yeah, and that's certainly something amazing. So I think a lot of times in the insurance industry, we do a needs analysis, and a lot of times we round to a certain figure, but it doesn't necessarily mean that you can't get more insurance. Now, that happened all really quickly, so I just want to show our people again. I'm just going to close this out, and I just want to repeat what we did again there. So you can see, we just threw in sort of a standard 35-year-old non-smoker. We might have done our needs analysis or matched a mortgage amount. Again, a lot of people might have even put $500 $500,000 of insurance to make that sort of an even number. But again, when we hit quote single life, single insured, and I'm just going to kind of bring up our same survey again. You can see you can go down any one in the list here, but certain companies, again, you can see $413.50 is the premium schedule for that $450,000. But I'll just show that again. This is the optimizer or OptiValue function inside of LifeGuide. And again, this little target is extremely powerful to make sure, again, we're getting the right sort of coverage for our client. So again, if we thought $450,000 was $413, again, when we optimize that amount, it happens very quickly, but you can see the premium stays the same. The face value is $551,706. So we're getting a lot more face value for the same exact premium. And again, that is always benefit to the consumer. And again, it makes you look good as an advisor as well, that you're looking for those little loopholes without necessarily charging your clients more. So it's in their best interest. I think this is a phenomenal feature. Can you tell me a little bit about the history of this feature? How did you come about this? And sort of maybe any other interesting tidbits about sort of the history of the kind of the optimizer or the OptiValue.
Well, in most cases, traditionally, life insurance is searched for by how much premium will it be for so much of face amount. And we get the premiums, and very often it's run on either a company software or on one of the websites, and it gives you a number for the premium. In this example, it would give us that $413.50, but there's the actuarial tables are not exactly linear. There are bumps at the band changes, and there are also other bumps that are in various cells in the rate tables. What happens here is through a process that's called iteration. Often there are opportunities for additional coverage for the consumer. And it's obviously in the best interest of the consumer to not only give them a suitable product, but also to give them the maximum that's available for the money. And we need to look at both the quantitative, which we did here, and the qualitative, which we can look at in a moment. And it's important to look at both. But the thought came upon realization that those actuarial tables and those rate tables are not necessarily linear. And companies do have certain sweet spots where they're more competitive than in other areas, just like a putter would have a sweet spot on it to get that ball into the hole. But let's look a moment at some of the qualitative side of things. Charlie, to the right side of the underwriting requirements, right there, keep going to the right, there is a little eye there. If you click on that, it will bring you a little bit more information, more detailed information in terms of the underwriting. And that's important, especially in situations where paramedicals may have been done within a certain period of time. Are they valid or are they not? Are the requirements cumulative or not cumulative in terms of coverage being requested for both life and CI, etc. So in this situation, it's identical. Let's close this window. If we want to take a look at the sample policy contract wording, we can go on the left side icons, down to the third one from the top. And if we click on it, it will bring up the sample policy contract.
Now, Ami, you also sort of touched on, you mentioned a word, something about competitive, and my mind couldn't help but wander, but think that, if you are in a competitive situation, I can't help but think that that would be an advantage to you as a broker. If your competition is proposing 450 for the, for a premium, and you get to come in and have, a lot more face value. I forget the, let me just pull it up here. It was 551. So if you're able to offer $100,000 more insurance for the same price, I can't help but think that helps in competition. And again, it's one of the reasons I think this makes a fantastic, life insurance life hack. So I really wanted to highlight it, and I really appreciate you coming on as a guest to share it with us. One of the other things, you have some pretty exciting stuff going on at the moment at CompuOffice, specifically with the LifeGuide product. And again, I'm fortunate enough to have a little bit of a sneak preview here. But this is LifeGuide Web. Can you tell us, a little bit about the launch and what you've been working on?
On October the 24th, we are releasing the WebLG, or in other words, the cloud edition of LifeGuide, which is essentially the same as in look and feel as the installed or desktop version of LifeGuide. However, it is entirely cloud-based, nothing to install, and you can use it on any device that you wish. It's also responsive, so you can shrink down the size of the window or expand the size of the window. Same functionality, plus some added functionality that we're adding into it, including such as instant access to the insurance company's website, or in the case of insurance companies who will cooperate with this, direct access to the sign-up page for an application for life insurance. The web version will also, or the WebLG, also with Charlie's cooperation, will integrate with LDA and all the benefits that LDA adds and provides for the consumer, and therefore for the advisor using it. One of the reasons that we're working together is that I was very impressed by the vision that Charlie and Larry had when I met them. It convinced me that this is something that's going to be great for the consumer and therefore great for the advisor. And what better way to get referrals than to provide excellent service? And I don't mean just suitable product, I mean to the best interest of the client. So that integration is going to benefit everyone. There is also, Charlie, if you go back to the quote screen of the WebLG, highlight any company, just pick one, and then go on the left side. If you click on the icon, let's say the second icon down, that brings you the cash flow within the policy. If you now click on the icon, the third icon from the left, or the first from the right there, that one, it will bring you a graph, and you can turn on or off any of the elements of the graph by just simply clicking on the headings. If you go down below there, coverage, take that off, and you can look at the premium flow, and so forth. If you click on the eye icon, close this one, Charlie, close this one, and hit the eye icon on the left. On the left, that's the one, yeah. You can take a look at the plan description in the narrative, and then there is the marketing info, which is also being expanded, and we've invited the MGAs across the country who represent various companies and would like to have their information listed to contact us for that. If you close this one, Charlie, and you go to the fourth icon down on the left side, looks like a house. It will take you to the home page of the insurance company. This is the icon that would also lead you to the application page for that product for those companies who decide to cooperate on this project, just to make things easier for everyone.
Fantastic. Well, very exciting announcements upcoming, and again, I look forward to this. I think by the time this webinar is recorded, you should expect to see that rollout of LifeGuide Web. But remember, so many mutual benefits of the two products. Remember that Opti search or the Opti value function within inside of LifeGuide, as well as that discount available to you. So if you're looking to turn those fantastic quotes and outputs from LifeGuide into palatable presentations for your clients, no better combination than the two of our products together. So again, Ami, I just wanted to thank you for being a part of our webinar. I hope I hope I opened some eyes to let this function out there. And again, if you haven't subscribed to LifeGuide, Ami, maybe tell us where we can go to subscribe.
There will be a page available on the 24th of October that I will announce on LinkedIn, and there will also be an announcement on For Advisors Only about the page. Of course, anyone who wants to is invited to call our office, 1-888-316-5433. Again, 1-888-316-5433, to go to the link and subscribe. I need to add here something, and that is that the arrangement that we have between Life Design Analysis and CompuOffice, where LifeGuide subscribers get the discount on their LDA fees, actually ends up in a situation wherein if you subscribe to both LifeGuide and LDA, you essentially end up getting LifeGuide at no cost, because of the difference in the cost for the LDA subscription. The difference itself amounts to what your LifeGuide is costing you, and sometimes a little bit more. So you actually end up making money at the moment that you subscribe to LifeGuide. And of course, using the two systems together brings about a situation where your competitive edge is increased very substantially, and it's increased that way because you are providing excellent service to the best interest of the client. So what it boils down to is that when an individual or a group get excellent service from a professional, they're much more likely to refer that professional to their colleagues, friends, and family. And there is nothing better than referred leads as opposed to bot leads or cold called leads. So that's what this will accomplish for you, and likely pay for itself in a very, very short period of time. Some MGAs are also assisting their team of producers by sponsoring their LifeGuide and LDA subscriptions. It's suggested that you check with your MGA. If your MGA doesn't, then you're missing out on quite a bit, because just getting printouts or just going to a website to look up a rate is not going to get you anywhere near what the combination of LifeGuide and Life Design Analysis will.
Very well said. One other kind of thought that's occurred to me when you mentioned the release of LifeGuide Web, you mentioned for advisors only. Just want to draw attention to for advisors only as well. If you aren't familiar, if you're an advisor and not familiar with this fantastic forum that we are proud to sponsor, LifeGuide as well as Life Design Analysis. As in terms of increasing knowledge and sort of finding some of these life insurance life hacks or these kind of best practices and tips and trends, a fantastic forum if you're not familiar with it already. So just want to draw a little bit of attention to FAO, just because Ami mentioned that when LifeGuide Web is released, he will be making an announcement here. So if you're not familiar with it, absolutely check out the opportunity. Well, Ami, I really want to thank you immensely. I think that's a fantastic synopsis and a little bit of a sneak preview of LifeGuide Web for all of our subscribers and viewers of the webinar. So I really appreciate your time, and I can't wait till the next webinar and some of the enhanced features that you spoke of. So thank you so much again.
Thank you, Charlie, for inviting me to this webinar. And again, thanks to everybody for coming and joining to watch. Looking forward to speaking with you. And again, I'm sure that Charlie will join me on this. If anyone has any questions, please do call and ask or email to ask. There's no such thing as a stupid question other than the one that's not asked. So by all means, if you have any questions, please call and ask or write and ask. Thanks again. Cheers.
Thanks, Ami. And yes, mentioned, you can reach out on live chat, call Ami, and we can always help connect you. Well, that's it for this topic. Moving on to our next topic. Now, our last update, we've made a couple tweaks in updates in the back end. So we've upgraded our PHP library and tried to increase the speed of the site, especially for those larger cases. You've also probably noticed a My Organizations tab if you're with particular MGAs. So we've started to roll out sort of our in-force automation pilot, which essentially takes our premier feature of that case automation where, again, any of your in-force policies, we sort of identify certain triggers and run recipes automatically to leverage opportunities within your in-force policy. So we've launched two significant ones recently, and again, if you're with Financial Horizons, you'll have noticed Canada Life in-force automation, as well as SSQ. We've launched in-force automation. So again, if you're interested in receiving some of those, or again, you should have had an invite to them, but if you're an existing subscriber and part of that MGA, you might have seen a few cases show up in your account. Again, these are carrier-sponsored cases and increased to help you really target in on those conversion opportunities, exchange opportunities, and things like that. If you are with another MGA, again, and interested in doing some sort of in-force automation to stimulate in-force business, certainly get in touch with us. Again, you can reach out on our contact page. If you just go into the support, you can send us a message. Again, partnering with lots of different carriers around this concept, and so far we've had a lot of great success with it. So if you've seen a couple, carrier cases show up in your account in your My Organizations, those are sponsored from the carriers. And again, if you've had a past expired account and are watching or are interested in receiving something like this, remember, do get in touch with us and please feel free to connect us with your MGA. So thank you so much. That brings us to the end of our webinar. Hopefully we have another great one for you next month, and look forward to your participation. Any questions, please send them to info@lifedesignanalysis. And as usual, the webinar is going to be recorded. It will be posted on our blog, which if you're logged in, you can find from the Help Center under blog. All of the past webinars are there. And you can see them there. They're also hosted on YouTube. So thank you so much. We'll send out CE credits within the next week or so for those provinces that apply. Thank you so much. Take care.